The automotive industry is facing an unprecedented crisis with 5 major warning signals indicating a dramatic price correction ahead. With auto loan debt reaching a staggering $1.7 trillion and dealership lots overflowing with unsold inventory, we're witnessing the perfect storm in the vehicle market. If you're planning to purchase a vehicle within the next year and a half, this information could potentially save you thousands of dollars. Following the pandemic, car prices experienced an extraordinary surge beginning in late 2020. Previously, consumers typically negotiated below MSRP, but supply shortages completely transformed car buying dynamics for several years after. Manufacturers reduced production due to anticipated decreased demand and severe supply chain disruptions, particularly affecting semiconductor chip availability. Simultaneously, stimulus payments boosted Americans' purchasing power, creating overwhelming demand amid historically low supply. Financial institutions dramatically loosened lending standards, approving loans for underqualified applicants in an eerily familiar pattern reminiscent of the subprime mortgage crisis. The first critical warning sign appeared through dealer markups. By January 2022, an astonishing 82% of Americans were paying above MSRP for new vehicles. Some models commanded 50-70 premiums, with one Ford Bronco selling for $83,000, a $45,000 markup above its $38,000 MSRP. This distorted market created the unprecedented situation where used vehicles often sold for more than their new counterparts. Even by August 2023, used car prices remained inflated 30% above normal levels. The second alarming signal involves financing problems. Millions who purchased overpriced vehicles between 2021 to 2023 now face negative equity situations. Nearly 25% of trade-ins toward new purchases are underwater by $10,000 or more, with the average negative equity hitting a record $6,838. Consider someone who financed that $80,000 Bronco in 2022 today worth only $35,040, potentially owing $30,040, more than the vehicle's current value. Similarly, a Tesla Model Y purchased for $72,000 might now be worth just $38,000, leaving owners with significant negative equity. Current financing statistics paint a dire picture. The average monthly payment for new vehicles has reached $742, with 1/6 of borrowers committing to payments exceeding $1,000 monthly. Interest rates have skyrocketed from 1-3 pre-pandemic to over 6% for new and 11.6% for used vehicles. Insurance costs have surged approximately 50% in just 3 to 4 years. Comparing identical Honda Accords purchased in 2021 versus 2025 demonstrates this financial burden. With higher interest rates and insurance premiums, the total 5-year ownership cost has increased by $7,200, representing 23% of the vehicle's MSRP without any additional value. The third warning sign, loan accessibility, is deteriorating rapidly. Nearly half of all loan applicants have faced rejection in the past year, indicating significant lending tightness in the market. The fourth indicator is inventory buildup. Unsold inventory has increased by 120% since 2023, with approximately 3 million vehicles sitting on dealership lots. Many manufacturers now have over 90 days of supply, a dramatic increase from 2022's average of 18 days. Despite increased incentives reaching 7.7% of transaction prices, inventory continues accumulating. The fifth warning involves industry panic signals. Major manufacturers including Stellantis, Ford, Nissan, and Volkswagen have implemented substantial workforce reductions. Nissan's situation appears particularly dire, with profits plummeting 90% year-over-year, prompting the elimination of 9,000 jobs globally and a 20% production capacity reduction. Their failed merger talks with Honda suggest deeper structural issues affecting the entire sector. Further complicating matters, recently implemented 25% tariffs on imported vehicles and parts affect approximately 45% of light vehicles in the United States. About 3.6 million vehicles manufactured in Canada and Mexico, and another 3.7 million imported from countries like Japan, Korea, and EU nations now face these tariffs. Studies suggest this could reduce imports by 74% and increase average prices by at least 5%. Dealerships must either absorb these costs or pass them to consumers who are already financially stretched, potentially further reducing demand. Luxury brands like Ferrari have already announced price increases up to 10% for the US market, likely establishing a trend others will follow. The automotive market appears headed for a significant reset. Without changes in the broader economic environment, vehicle prices may finally decrease to fair market values, though tariffs create additional uncertainty. Markets remain unpredictable, defying traditional economic expectations. If you're currently underwater on an auto loan, avoid digging a deeper financial hole. Consider holding your current vehicle until reaching positive equity or paying it off completely.